All right, so today we are sitting down with the Handy Andy Realtor Team lender partner, Aaron Knutson. And Aaron can help you figure out exactly what type of loan product would be best for your needs. But today we're going to talk about the differences between some of the more popular loan types that are out there. FHA, conventional, we're going to talk about the VA loan and the somewhat popular rural development loan, which is a zero down loan program that you may have heard of. So Aaron, tell us about the differences between some of those loan products and why it's so important that buyers understand this.
Okay. The big things that you'd want to know right away are down payment. Down payment for an FHA loan is going to require 3.5% for the down payment. That's of the purchase price. Conventional loans are going to require a little bit more, 5% down payment, and VA and RD are going to be 0% down payment requirement.
Okay.
Which nice gives you a little bit of option.
So on RD you could get in with zero down, especially, and then if you were also a veteran you could get in with zero down. Otherwise, conventional and FHA you're going to have some kind of down payment.
Correct.
A lot of buyers assume they have to have 20% down. That's not the case.
No, that's not the case. You can actually get into a home with 0% down payment.
Great. Okay.
The next thing I would go through is gift options, meaning the down payment where it can come from. With FHA, 100% of that 3.5% down payment can be a gift. Family member, friend, as long as you have a common relationship with them. Conventional loans, anything above the 5% down payment can be a gift. So in other words, you have to come in with the full 5% down payment on your own. VA and RD, obviously there's 0% down payment, so any gift is for closing costs, prepaids, anything like that.
Okay, great.
Mortgage insurance would be the next important category that we need to talk about. With FHA, there is a higher mortgage insurance premium. As you can see, it's 1.35% monthly mortgage insurance premium. And anything over 90% loan to value, that's going to require that for the life of the loan. So a 30-year program is going to require it for the full 30-year term.
And that was a recent change, wasn't it? It used to be where it didn't have to be the life of the loan, but they recently changed that.
Correct. That just changed in June.
Okay.
Where conventional financing is variable monthly, it's dependent on your credit scores, and you have to have that when you have a down payment less than 20%. VA and RD, there's two different loans, so two different programs. VA, there's no monthly mortgage insurance premium, but there is a funding fee that you pay at closing. That can be financed. With RD, there's a monthly funding fee that decreases based on your current balance.
Okay.
It's also much cheaper. It's about a third as much as the FHA mortgage insurance premium.
I see. So what you're saying is that on FHA loans, there's really no way to get around it unless you're, depending on your loan to value ratios, but that's going to stay on the life of the loan no matter how long you have it. On a conventional loan, if you put 20% down, you could avoid mortgage insurance altogether?
Correct.
Okay. And how much would a mortgage insurance be? I mean, what would people expect for a mortgage insurance payment?
You're looking anywhere from 60 to usually 85 basis points, depending on your credit scores, how much down payment you're putting down, and the property.
Okay, so it all depends on there's some variables there. It depends on maybe the purchase price of the property and things like that. But it could be it could be 50, it could be 100, it could be a couple $100 a month that you have to pay in mortgage insurance that if you put 20% down, you don't have to pay.
Correct.
Okay. And then you had mentioned that on a VA, there is kind of a monthly mortgage insurance premium, but that decreases as your loan value goes down. So over the years, that gets less and less.
So that's on RD, yes.
I'm sorry, on RD loans.
Yep.
Okay.
On RD, there is that, and it's an annual funding fee, they call it, but it's broken down by month.
Okay.
That decreases annually as your balance also decreases.
Great. Okay.
The next thing is SPCC, or seller paid closing costs. You can ask the seller to pay some closing costs, and I always suggest that you speak with your realtor, the Handy Andy team, to discuss what that means with your offer. But I like to let you know what the maximums are available out there. With FHA, you can request 6% seller paid closing costs, or with conventional, only 3%. VA is 4%, and RD is actually 6%. So that can help you with some less cash out of pocket at closing.
Great. Okay. Cool.
Interest rates, that's obviously the big question that everybody asks about. Historically, FHA rates are less than conventional rates, and RD is similar to FHA. I should say RD and VA are similar to FHA rates. Conventional rates are slightly higher. Not a whole lot right now. It's going to depend on credit and that kind of stuff with conventional rates most likely. Appraisal guidelines. I always mention this to borrowers is FHA has some stricter appraisal guidelines, property specific things, and then I lean on our handy realtors to let us know a little bit more about the property itself and if it would pass FHA appraisal guidelines.
So yeah, I mean, this comes up all the time. People say, hey Andy, we're doing an FHA loan, we want to go ahead and see this property, and we have to be very careful when we go look at that property to look for things like curling shingles, chipping paint, missing hand railings, outdated electrical service. These are all things that can stop an FHA loan in its tracks, right?
Correct.
So, borrowers need to be pretty sure they know what type of financing they're going to do before they go out and look at a bunch of homes, because they could find one they like and find out that it won't work, right?
Correct. It could not maybe qualify because of the property itself.
Okay.
Or obviously being qualified for.
Yeah, which is big right now with the foreclosures that are in the market. There are a lot of them that need work, and buyers want to purchase them, but unfortunately, if an FHA type of situation, they may not be able to.
Correct. The seller would possibly be able to make those improvements or fixes, but in the foreclosure case, a lot of those financial institutions that own those properties are not making those changes or fixes to the property that's as is. Conventional conventional appraisals are going to be health and safety type of issues where mold, mildew, that kind of stuff in the property are going to be issues that'll need to be corrected prior to closing.
Gotcha. Okay, so conventional is a little bit more lenient on what kind of type of a home you can buy.
Correct.
Gotcha.
Correct.
Okay.
And same thing with FHA as RD and VA for guidelines on the appraisal.
Okay, so VA and RD follow those same FHA guidelines.
Correct.
Okay.
Correct. Location. Most properties you can purchase using FHA or conventional, and VA also. But rural development has a property specific per its location. They want to encourage people to purchase properties within a rural community.
Okay, so in other words, it has to be outside of a larger area. It has to be a smaller town, basically.
Yep, like for our area, Rochester, Minnesota, it's going to be outside of our area.
Okay. All right, great. So, those are the difference between the different loan programs that are out there. If you have more questions, please contact us or Aaron directly at the information below, and he'll get you pre-qualified, find out what it is you can afford, talk about these different loan programs, find out what the best program is for you, and you can be a prepared buyer when you do go to start looking at homes. Thanks for watching.